In the second session, where I talked about risk-sharing banking models. And again, it has to do with addressing the problem of banking fragility. The banking model, as we know, is highly fragile because banks work on high leverage. Their equity portion is minute compared to the total assets. So there's a lot of leveraging. But in addition to that, banking has maturity because they are involved in maturity transformation. That means essentially the bank borrows short, lends long. What that means is you will always have these liquidity problems. So you have a number of things in conventional banking models. You have leverage issue. You have the issue of liquidity problems. And of course, given the kind of business that they do, credit risk. So these are all problems that essentially mean that banking is highly fragile, and therefore you have crash after crash after crash. Many times banks and banking systems have failed. But what keeps it going really is the fact that there is all these external scaffolding. Things like deposit guarantee, deposit insurance, lender of last resort, competitive regulation of competition, regulation of many of the products, services, etc. So all of that are external things that's brought about to keep that banking model going. Okay. But what we propose is to say, again, in Islamic finance, Islamic banks are not supposed to be in the business of risk transfer. They're really supposed to be doing risk sharing. What that means is, if you go into risk sharing, you have to go into the real sector, direct investments. So we propose that basically the banking system, if you look at the asset side and liability side, on the asset side, the Islamic bank can give murabaha, ijara, diminishing musharaka, project financing under mudaraba, musharaka, etc. And then what they would do is, once they've given out those funds as funding, customer funding, they turn around and issue sukuk. So for example, if a bank has given 50 million ringgit or dollars worth of diminishing musharaka, home mortgages, they turn around and issue diminishing musharaka sukuk for $50 million. And the maturity of the sukuk matches the average duration of the loan portfolio. So what that means is there is one-to-one tagging. So the sukuk holders get a return based on the returns from the funding that's given. So essentially what's happening is, instead of the bank taking on all the risk, there is risk sharing. Okay, essentially mutual fund model. In other words, the bank, Islamic bank, becomes more like a mutual fund. And once you are like a mutual fund, because it's a risk sharing mode, it's inevitably much more stable. And you avoid many of the crashes that banks have. And we also propose, in other words, the proposed Islamic banking model will be doing a lot of securitization. And we propose that these securitized papers be traded in secondary markets. It's important that we have secondary market trading, because then you really do away with the maturity mismatch problem. And sukuk investors can sell those sukuk and liquefy and get their money at any time they want. They don't have to wait for maturity. So it really adds to a lot of advantages. But most importantly, once you have active trading of those securitized papers put out by the many Islamic banks, then the big important advantage is we can truly move away from this reliance on interest rates, or even for the pricing guidance, etc. For example, once you have the active trading, you can determine what is the yield or what's the market required return for murabaha, papers of 6-month maturity, or murabaha loans of 3-year maturity. Similarly, what's the yield for ijara? What is the yield for diminishing musharaka? What's the required yield for mudaraba type projects of a certain tenor, etc. So effectively, you have price discovery. And price discovery basically meaning you have, the banks get to know what their cost of funds is. And of course that leads to a lot more efficiencies with regards to allocation of resources. So there are all these good things that can happen. One of the control mechanisms is if you want to avoid a US subprime crisis type of situation, where again there was securitization. So we propose in this paper that a portion of those funding, of those customer financing, let us say 10%, must be kept on the bank's balance sheet using its shareholder funds. In other words, if a bank has given out 100 million under ijara funding, they can only put out 90 million of those papers. 10% has to be kept on their books. And we also say that, if you want to be very strict with the banks, you can require that the first loss provision come from that first 10%. In other words, if there's any diminution in value because of NPLs, etc., the first loss goes from that 10%. And that will ensure that the banks continue to be very careful about where they lend and who they lend to, etc. Even though they're going to be securitizing the paper.